Hi, everyone. I hope your day is treating you well so far. Welcome to this special edition of the BigSpeak Webinar. This is the Washington Update, the CARES Act Translated with Jeff Bush. I'm Marianne Kuga, Marketing Manager at BigSpeak, and we're going to get right into it today because there's a lot to cover, and I know there are a lot of questions. So today I am joined by Jeff Bush from the Washington Update, who will be taking us through the pieces of the newly signed CARES Act and translating what it means for all of us. I know we usually broadcast on Wednesdays, but we also know that this information is timely and important and wanted to get it to you as soon as possible. Before I turn it over to Jeff, if you've been joining us before, you'll notice we have switched platforms for the series and things look a little different. You can still submit your questions via the questions button, and Jeff will be answering them following his presentation. And you can also use the chat function to send us messages. We are recording this and we'll be distributing it to all attendees and registrants tomorrow morning. And with that, Jeff, I will turn it over to you, but I see we still have people joining. So if you want to just give yourself a quick introduction,
Sure.
just to give people a chance to get in. So.
All right, sounds good, Marianne. Thank you so much. Well, good morning, good afternoon, depending on where you're viewing this WebEx. But I do appreciate the opportunity to be here today. The Washington Update is a very nonpartisan look at what's happening in Washington, D.C. And we try to translate all that noise that we hear on the evening news or in the newspaper into actionable ideas for business owners, high-income individuals, high-net-worth individuals, financial advisors, really a large scope of the population. They're attuned to how Washington is impacting their daily decision making. So we just try to give you that perspective, and again, in a very nonpartisan way. Now, today we're going to talk about the CARES Act, and as you know, it's an 880-page law, so it's pretty thick, if you will. And so today's minute is a very high level look at that. When we get into granular things around your particular situation, that's probably most appropriate to deal with your local banker or your CPA. And I hope you'll also allow me a little bit of flexibility with some humor today. I know all of us probably could use a laugh, but you know, it's a difficult time without a doubt. Now, along those lines of what we want to talk about today, and pardon me, I need to click here. What I want to mention is I want to talk about some things that are happening around Washington, D.C. But before I get started, and I already clicked to that slide, you saw it, but bottom line, I wanted to give you a metaphor, a picture for how politics has felt over the last 3 years. And it wasn't until I came across this picture of this road sign that I thought, oh my gosh, that's perfect. That's exactly how Washington has felt. We thought we had a direction. We thought we knew where we were going. We got turned around, we got sideswiped by a few tweets every now and then, and obviously we've been hit from left field around this coronavirus issue. But it is that backdrop that I thought, you know, what we ought to talk about today certainly is the CARES Act, no doubt about that. But that CARES Act has fiscal policy implications that we need to understand as business leaders and also towards the election. But I actually want to take a little bit of a step back and remind audiences that there were some changes around 401ks and IRAs at the end of 2019. I know a lot of us on this call are business owners and we're responsible for this, and we're certainly all employees and we want to understand some of those changes. Interestingly, you may not know that 41% of American employees lack access to a qualified retirement plan at work. And the federal government's very concerned about that. They want to drive that number down. So one way they did that is through the Secure Act, which passed at the end of 2019. What it does is allow small business owners to join together into multi-employer pension plans to share the lower cost of a larger plan. That hopefully will allow small business owners to offset the higher administrative costs of 401ks and make it more cost effective to offer that to their employees. In addition to that, for startup plans and plans that add automatic enrollment, there are some tax credits involved as well. What you should also understand is that traditionally 401k eligibility was based on 1,000 hours per year for that employee. That now is actually 500 hours per year. Now, as a business owner, you'll understand 500 hours a year on a permanent part-time employee basis, that's less than 10 hours a week. So it certainly could impact who's even eligible for your 401k at the workspace. Now, the other thing the federal government's very concerned about is that the mass majority of Americans are showing up in retirement and their only source of guaranteed lifetime income is Social Security. Well, ladies and gentlemen, Social Security was never meant to be our only source of retirement income. So the federal government is making it easier to add lifetime income products inside of these 401k plans. And if you're a business owner, you know we've been able to add these lifetime income products in the plans for some time, but we didn't choose to do it. And the reason we chose not to do it is because there was some fiduciary liability involved in making that choice of an investment option in our plan. Well, the federal government's now given us some safe harbor rules that we can follow. As long as you follow those safe harbor rules, you get some fiduciary liability protection for offering that lifetime income product in your plan. It also eases portability of those lifetime income products should that employee leave your employee and go elsewhere. But there are also some changes around the IRA front that I want to mention. For example, they increased the age limit for required minimum distributions from 70 and a half to 72. So for those individuals who weren't quite yet 70 and a half at the end of last year, they have a little more time before they're forced to take money out of that IRA. In addition to that, they also repealed the maximum contribution age to IRAs as well. We were capped at 70 and a half, even though Americans were living longer and working longer, they could no longer fund their IRA. Well, that cap now is removed. So if an American's working and they're wanting to save for their own retirement, they can certainly continue to do that. Now, this bill was what they call paid for, and what I mean by that in Washington is not the way you and I would pay for something. It means that there was a revenue offset that at least made it politically look like they could vote for this additional spending. And the way they paid for the Secure Act was through the elimination of stretch IRAs. You may be aware that when someone passes away owning an IRA, they can pass that IRA to the next generation. When that next generation inherits that IRA, they were forced to take distributions out, but they only had to take distributions out based on their remaining life expectancy, therefore stretching that IRA tax deferral. Well, that stretching option is no longer available. Now, if you inherit an IRA, say from your parents or grandparents, you would have to get that money out over 10 years. So that does change some of the ways we can access those monies in the event of a wealth transfer event. But I know we're here to talk about the CARES Act and the coronavirus stimulus and rescue plan, so let's kind of jump right into that. Now, it's often said that nothing actually gets done in Washington during election year, and that's generally true. But what we found with the coronavirus legislation is if you're willing to spend trillions of dollars, you can get bipartisan support. And that's exactly what we see around this whole initiative around the coronavirus stimulus. We started with round one, which was just a down payment. It wasn't even a down payment. It was a mere fact of, of saying, I want to buy the car, let alone going and actually applying for the loan. This down payment was just to get things started. Really, round two is where the stimulus really started to happen, and it started by mandated sick leave for companies with less than 500 employees. Now, sick leave is that 2-week period where an individual, either they're sick or they're caring for someone who's sick, would be paid in order to avoid going to work and obviously exposing other people to that sickness. Now, those dollar amounts are capped at $511 a day for a full-time employee and $200 a day for a part-time employee. But the federal government wanted to go beyond that. They wanted to go beyond the 2 weeks. They actually wanted to increase the family medical leave program to companies under 500 employees as well. That's the 12-week program. The individual can take that time to care for themselves or care for a family member, in this case, coronavirus. Now, that would be capped at 2/3 of someone's regular pay at $200 a day. Now, as an employer, if you're the business owner, you're saying, ooh, this sounds very expensive. And you're absolutely right, it's not going to be cheap at all. But the federal government are helping these small and medium-sized employers by giving you refundable tax credits against your FICA taxes to actually implement these programs. So that should offset that, but and ease some of that cash flow burden. In addition to that, the federal government knew that unemployment was going to rise significantly, so they immediately bolstered states' unemployment programs with $1 billion from the federal government. They had nutritional support for the young and elderly, along with free coronavirus testing, not care, free testing for the coronavirus, and they increased state Medicaid funding by 6.2%. Historically, the federal government pitched in about 56% of Medicaid costs, but now that's in the mid-60s, if you will, or lower 60s%, because the federal government knew with people losing their jobs, there were going to be more and more people join those Medicare ranks. More tactically, they also extended the tax deadline from April 15th to July 15th. Now that's exciting because that includes quarterly estimates, tax filing, your tax payment. It even includes your 2019 IRA contribution deadline. So it gives us a lot of flexibility as individual filers and business owners in that light. Now it does waive the pay-go requirements, and I apologize for getting into the weeds, but this is very important. Right now, there's a rule within Congress that says any bill that gets passed has to fall under pay-go. Pay-go simply means that if you spend $1, you have to find $1 in cuts elsewhere in order to pay for that spend. Well, they suspended pay-go for round 2, and it's a big wave. It's a waiver of $150 billion in extra spending. So we spent $8 billion, now we're spending $150 billion on round 2. But we know round 3 was even bigger than round 2, oh, hugely bigger. And they waived pay-go for round 3 as well. And that's where we'll get into the fiscal talk here in a moment. Now, the most visible part of the round 3 program are the checks going out to every single taxpayer that earns less than $75,000 or $150,000 as a married couple. In addition to that, for every child, you'll receive a check of $500, and those limits are phased out between $75,000 and $99,000 for an individual, and $150,000 and $198,000 for couples. Now, there are some questions as to how this money is going to get to you and I. The mass majority of it will come in the form of a direct deposit. So if you filed your taxes and you filed your taxes with a direct deposit form, that money will go directly into your account. You really don't need to do anything. It's based on your most recent tax filing, be that 2018 or 2019. There are some unique circumstances where someone may not have filed even their 2018 taxes yet. There's as well as older individuals or disabled individuals who aren't required to file for the federal taxes. There's a simplified tax form that you can fill out that includes that banking information in order to receive that check. Now, the second part of the round 3 for you and I as individuals is around some flexibility around qualified plans. Right now, we know if we put money into a 401k or an IRA, if we should have to take that money out for whatever reason, there's not only a taxable event, there's also a 10% penalty for that early withdrawal. Well, under the round 3 program, they've waived that early withdrawal penalty. If you're under 59 and a half, you can take up to $100,000 out of your qualified plans or your IRA in order to meet your cash flow needs. Now, understand that money is still taxable. It's taxable, but you have 3 years to pay that taxes. So you can spread that tax liability out over those 3 years. And even more importantly, once we get this economy working again, you're able to put that money back into your IRA without any taxation concerns. So that's some flexibility. Now, I do want to say right now, especially with the market down the way it is, that should absolutely be the last place that you try to get access to capital at this time. But it's nice to know we have some of that flexibility. Interestingly, they also waived the required minimum distributions for 401ks and IRAs this year. So if you are over 70 and a half and you are subject to required minimum distributions, you don't have to take it this year. That's just kind of a gift from the federal government. If your company has a defined benefit plan, we know those payments can be rather large. And so they've delayed that payment deadline for 2020 contributions to January of 2021. Just to give you and I, again, additional flexibility in our cash flow in this challenging time. Now, we talked about unemployment insurance earlier, that the federal government bolstered the state program with $1 billion, but now they've layered on a new program on top of that and increased the unemployment program by $600 per week. Now, a lot of Republicans were concerned about that because that literally means there are going to be certainly hundreds of thousands, if not millions of American workers that will actually earn more receiving unemployment than they did when they were working. And the Republicans were concerned that that would provide a disincentive of those people coming back to work. Well, that got passed anyway, and so that's no longer a concern. What it also allows you and I to do is to make charitable deductions regardless of income limitations. You may recall if you're a sizable charitable giver on an annual basis, there's some limitations to what you can give as a percentage of your income. Well, that goes away. The federal government wanted to open up the floodgates to large charitable gifts, and this is their way to actually make that happen. If you have a student loan, you're able to suspend that student loan payment until September 30th. If your employer pays a portion of your student loan liability, those are actually tax-free to the student under this new program. They increase food stamps and farm bailouts and some other ancillary things. But I really want to focus on the business aspect of the round three. I think that's where a lot of us are very focused at this point, most of us being business owners and certainly business leaders. One of the things they did inside this program is to defer the Social Security liabilities, and they deferred those, and we can spread that tax liability out over 2 years, 2021 and 2022. Again, that just keeps more cash in the business so that we have flexibility as to what we need to do with that cash. Now understand that's the employer share only, not the employee share. Interestingly, they also added self-employed individuals to that deferral, which was somewhat of a surprise. I didn't think that would actually get done, but it absolutely did. Now, there's also some refundable employment tax credits in the amount of 50% if you're paying wages and your business is forced to close. And that tax can be taken, or credit can be taken as against your employment taxes due later on. There are also some additional flexibility around net operating losses. We've been limited on those, as you know. And so now that's been expanded along with our ability to take a deduction for the business interest that we're paying on loans or equipment and so forth. Now, the biggest thing that we've all heard about is this new line of credit open to small business owners through the SBA. The goal of that will be to cover your existing loan payments for 6 months for existing SBA loans. But the other side of it is that new line of credit, over $350 billion that's available to small business owners, and they can access that through your local SBA lender. If you are working with a current lender, it's important, and you're concerned that you might need to access some of that money, make sure you get on the radar of that lender sooner rather than later. Make sure they know that you're interested in it so they keep you up to date with what's happening around that loan program. If your current banker doesn't have access to SBA, find a banker that does. I'm sure somewhere in your network of clients, you'll find one that has that. Again, that's access through local SBA lenders. And that money can be used for a broad range of things: compensation, paid medical sick leave, as we talked about earlier, insurance premiums, mortgage payments, utility payments. All of those things can fall under the opportunity to use this program. And we don't have to pay that loan back starting for at least for up to 1 year. Now, in addition to that, the portion of this loan from the SBA actually can be forgivable. It can be forgivable to the extent that we use it to pay interest on your existing mortgage. Now, you can't name more than the principal amount, obviously. That would be too good to be true. But you can also use it for rent expense and on an existing lease, as well as your employee compensation. So those are great opportunities that literally would theoretically be free money from the federal government just to keep your employees paid in order to keep this economy moving forward. Now, those employee compensation rules will be adjusted a little bit. They'll be reduced proportionally by any employees that earn over $100,000. That portion would be reduced, as well as they would compare the number of employees you have this year that you're retaining versus what you had last year. If there's a big drop off there, then you're going to get a reduced forgiveness amount. In addition to that, if you decrease employee pay by more than 25% versus the prior year, that also is a reduction issue. Now, you won't be penalized if you have to lay employees off and then you rehire them. The trick being you have to rehire them once our economy gets going again. So this gives us a lot of flexibility. Quite honestly, your local SBA lenders, they don't have a lot of parameters on these loans yet. They have promised us that they're going to be as short as same-day approvals, where you'll be able to go in, do the paperwork. If you have all your documents ready, you'll be able to theoretically walk out of the bank that day with a check. Now, I'm sure it won't be quite that easy. We are dealing with the federal government, but every effort's being made to expedite the cash flow because they know businesses are going to need this money very quickly, especially thin margin businesses like restaurants and the like. Now, also, there's a bailout. No, I'm sorry, I shouldn't have used that term. It's not a bailout program. It's a program for large companies. Think like Boeing and FedEx and CVS and all those big companies. These are loans and loan guarantees and so forth, and for businesses who are at risk of mortal losses. Mortal losses being, think about the airlines right now. We know that fares or seats are down by about 90%. Well, that business model simply doesn't work flying all the airplanes around the country. Now, these loans would be for large companies generally. It's going to be a maximum of 5 years, and there are a lot of limitations on these loans. For example, during this loan period, plus 1 year, they can't do stock buyback programs. That was something the Democrats were very focused on, that these monies would not be perceived as a bailout. And if a company received money and they were still buying back stock, clearly that company didn't need a loan. In addition to that, they would have to suspend dividend payments for the term of the loan plus 1 year. And they would also have to maintain existing employment levels, quote unquote, to the extent practicable. Now that's a little bit of a foggy word, I think we would all agree, or phrase, and the Democrats wanted much harder language on that. They lost that argument and they moved forward with the extent practicable type of standard. Now, in addition to that, they also have to limit total compensation for executives and so forth during the time of the loan plus that 1 year. In addition to that, there are some other companies that, bottom line, they're going to get set-asides, and that's for the airlines, the air cargo people who are clearly very challenged in this type of environment. Now, these things are subject to an oversight board as well as an inspector general. That inspector general review will report to Congress on a weekly or monthly basis where these loans are going and for who, to whom, and for how much, and so forth. So that can be reported publicly. That was the biggest concern the Democrats had, that this would just be a black hole of slush money going to corporations. And they prevented that by including this inspector general. In addition to that, the president, the vice president, and cabinet officials, any company that they're involved with, including their families, would not be eligible for this type of industrial loan guarantees and so forth. Now, in addition to that, they also liberalize some of the banking and accounting rules so that it frees up more liquidity in the marketplace so that those companies can access larger lines of credit. There was also an infusion directly from the federal government into state government and healthcare. Obviously, we know those industries are having significant challenges right now, and they want money to go directly to those programs. Now, all of these things sound very expensive, and you're absolutely right. Just that industry program is $500 billion. The small business program we talked about is $377 billion. So when you add all that up, it gets to be a real number very, very quickly. It's actually $2.2 trillion. Now, I've been in the financial business since 1987, and even with my background, it's hard for me to think in terms of $1 trillion. So I want to put it in terms that we can all kind of get our head around. Most of us spend a lot of time, or we used to, on airplanes. So I'm going to talk about it in terms of frequent flyer miles. Let's say, for example, you decide to take a round trip, but it's a really long round trip. You're going to fly from the Earth to the moon and back. Well, if you made that one round trip airline ticket, it would give you 490,000 airline miles for that one trip. I think we'd agree that would be a long flight. But if you wanted to actually build an account balance of $2.2 trillion frequent flyer miles at 490,000 miles per trip, you would have to take 4.5 million round trips to the Earth, to the moon and back. So it's a big number that we need to kind of keep in mind, and that big number has fiscal implications. Now, to put it another way, if you think of every single dollar the federal government brings in revenue, every single federal tax, every single excise tax, every single user fee that the federal government brings in, that entire bucket of money on an annual basis is about $3.5 trillion. Well, ladies and gentlemen, just round 3 of $2.2 trillion is going to be spent in the next 8 weeks or so. So that gives you an idea of what kind of investment we're having to make in our economy right now. And what about round 4? We're already talking about what round 4 should look like. There's talk about an infrastructure investment that would not only provide economic potential, growth potential, but it would also provide jobs, which obviously is going to be very important. They're also talking about filling some of the gaps that didn't get filled with round 3, and a lot of different priorities there. And we have no idea what that might look like, but believe me, they're already talking about it, even as we're trying to figure out how to implement round 3. Now, as I mentioned, there are fiscal policy implications of this. So let's talk about fiscal policy a little bit. It was just in January that President Trump said, who the heck cares about the budget? Well, he used a little more colorful language than that. I won't say it, but he certainly made that comment. Well, Mr. President, I care about the budget. I think budgets are important. So let's kind of review what happened in fiscal year 2019. The good news is that corporate or tax revenues were up. Tax revenues up to the federal government were up 4%. The bad news is, though, the expenditures, what the federal government spent money on, went up 8%. Now, that's not a very good business model, but that's not unusual for the federal government. But what was a little bit unusual is the annual budget deficit grew by 26%. Now, that's a huge year-over-year increase, huge. And if that was our personal budget, we'd want to sit down with our significant other and say, well, what happened? Let's diagnose what changed in 2019 over 2018. Well, we've talked about for years, and some of you may know because we work together, that Social Security and Medicare are growing significantly because of the baby boom generation, and that's certainly a part of that year-over-year deficit growth. But make no mistake about it, ladies and gentlemen, the lion's share of this year-over-year deficit growth came from this year's share, the $1.5 trillion in additional debt added by the Tax Cuts and Jobs Act of 2017, and the $500 billion that Democrats and Republicans got together on and just mutually agreed to spend that $500 billion above the budget control limits last March. That's what drove that year-over-year deficit growth. And ladies and gentlemen, that combined with the debt limit deal that we did in August of last year guarantees that we're going to have $1 trillion plus annual budget deficits moving forward. Now, I should explain, what is the annual budget deficit? It's really made up of two things. There's primary deficit, which is in the darker color here, and then interest only on our federal debt. Now, primary deficit just means that the federal or Congress allocated more money than they brought in on an annual basis, and so they're paying for whatever they decide to spend the money on. But the interest is the interesting one. The interest is the interest only on our federal debt. You see, you may not know this, but we've racked up 23 trillion or so in federal debt, and there is no plan to pay that 23 trillion off. The plan is that we're going to pay interest only in perpetuity for that growing amount of debt. Well, ladies and gentlemen, I don't care how low interest rates stay and for how long they stay low. If you're growing debt as quickly as we're growing it, it's going to become a larger share of your deficit. And that's exactly what we're starting to see happen. You're starting to see that lighter portion, that lighter color, starting to grow significantly. To put that another way, the long-term average debt deficit on an annual basis is about 3% of GDP, or 3% of our economy. Well, projecting forward, now this is all pre-coronavirus, that the annual budget deficit now is projected to be 4.8%, a 60% increase in our annual budget deficit before coronavirus. Now, you see, we don't really have an income problem or revenue problem. Our revenues are about average. What's happening in our dynamics is that we've added so much debt since 2008 that it's the interest on that debt that's causing our spending to go up. And this is, again, before coronavirus. And I want to point out, you remember the 2008 financial crisis? There was that huge, unprecedentedly large, until last week, unprecedentedly large fiscal stimulus bill. Well, that bill, ladies and gentlemen, was only $870 billion. 870 compared to 2.3 trillion under this coronavirus issue so far. So you can imagine what that 2008 financial crisis bailout did is it reset the debt to GDP ratio in our country. Immediately over a 1.5, 2 year period, you see that huge lift in the debt to GDP ratio, and it set us on this course of long-term unsustainable debt flows. Well, again, that's 870 billion. Now we're spending 2.3 trillion. So you can imagine what's going to happen to that curve. I know a lot of you are saying, well, we just need to get people back to work, and that's certainly a part of it, but we really are testing something called the modern monetary theory, or also known as MMT. What MMT suggests is that as long as a country has the ability to print its own currency, they don't have to worry about debt. They can write as much debt as they want because they can print their own currency and just print money to pay for that debt. Well, you know what? Absolutely, modern monetary theory, MMT, will absolutely, positively work. I guarantee it, until the day it doesn't. And the problem is you never know what that day is. That day is when the people who are buying your debt, that includes you and I, includes our pension funds, includes our insurance companies, certainly includes other countries around the world. It's the day that those buyers say, you know what? I don't like your balance sheet, United States. I want a little more interest to take on that risk. And that's when we really have a problem. That's when we see that exponential growth in that curve. And even if we get people back to work, and right now, believe it or not, we're actually ahead of the labor participation curve. There are more Americans working up until 2 weeks ago than we had ever expected at this time. You see, labor participation was always going to go down. It had to go down as Americans are aging and aging out of the workforce. So right now, up until coronavirus, we're actually ahead of the curve. Well, we know what's going to happen. Some people are calling for as much as scary as it sounds, as much as a 30% unemployment rate. Now, 2008, we hit about 10, a little over 10% in some cases. So you can see that in comparison there. Now, we also have monetary policy. This is the Fed, and the Fed is suggesting that, well, actually did lower the lending rate from 0 to 25 basis points, so effectively zero for lending. They've said unlimited quantitative easing. In other words, they'll keep buying bonds as long as they have to in order to support our economy. And they're easing those lending standards. So that combined with that $507 billion from round 3, the Fed believes they can lever that lending up to $4 trillion of stimulus inside the US economy based on round 3. Now, all of these things will eventually trickle down to the fact that we have an election this year. It seems to be forgotten lately, but we are having a national election, so I wanted to spend some time on that. And I think Will Rogers said it best when he said, I'm not a member of any organized party. I'm a Democrat. And I think that perfectly explains where the Democrats are in 2020. You see, they were desperately hoping that you and I, the electorate, would have given them clear guidance as to who we wanted them to be in 2020 back in 2018. And we didn't do it. We elected very moderate Democrats. We elected very progressive Democrats. So it really left this whole field of, anybody could be the president of the United States on the Democratic ticket. And that's what we've seen play out through this primary process. And the good news is we've finally gotten everything we could ever have hoped for. We have finally gotten 2 70-plus-year-old white guys facing off with a 70-year-old plus white guy. Now, of course, I say that in jest, but the reality is right now, that's where we stand. Clearly, that's where the party is heading at the moment. There's a lot of other talk, but it really is not changing the dynamic. The dynamic has not changed in this Democratic primary one bit, no matter how we've winnowed the field. It's still a difference between the progressive Democrats and the moderate Democrats. And here's something you should know about US politics. The US political system is a process of creative destruction. And what we're seeing happen within the Democratic Party is absolutely predictable. Ladies and gentlemen, the moment either party garners enough support to actually have a majority, by definition, that majority will be fractured and will eventually cleave. And that's what we're seeing happen within the Democratic ranks right now. There's this divide between the progressive and moderates. The progressives believe that for whatever reason, 2020 is the year, the absolute unique year that they can actually make fundamental changes as to the role of the federal government. And of course, the coronavirus is making some of that case for them as well. But what we do know is that they're talking about things like Medicare for all and New Green New Deal and so forth. And that progressive turn within the Democratic Party is what's creating a lot of this volatility. A lot of concern early in the volatility in 2020 was around political volatility. Well, of course, now it's coronavirus, but back then it was political volatility. And the more progressive or moderate Democrats, quite honestly, they just want to beat Trump. As long as they put a wooden donkey up there with a D behind its name, they'll vote for it just to vote against Trump. So that's what's playing out in the Democratic primary race. And we saw this dramatic switch with Super Tuesday. We're going into that. All the talk was that Bernie Sanders may be unstoppable after Super Tuesday. And we know what happened. The exact opposite thing happened. The more moderate Democrats came into play and actually gave Joe Biden a lot of momentum lift through Super Tuesday. And once he got through Super Tuesday, it was all about these middle term primaries. Some now, which have been delayed, of course, until June and so forth. But these middle primaries, the ones that we're in right now, they were always going to heavily favor the more moderate Democrat. So it shouldn't surprise anybody that Joe Biden has now taken off in that delegate lead. Now, what we do know is all about electability. And if you look at any poll around electability, Joe Biden, Bernie Sanders, they're all within the margin of error of beating Trump. So it really is a more traditional election than most people are going to assume. A lot of people think this is going to be a wave election. I'm just not seeing that based on what we know right now. President Trump has got a little bit of a lift from the coronavirus issue, which would be expected. But I think, quite honestly, longer term, the real challenge will be around how he handles it. And I'll get into that in a moment. There is some discussion about a brokered convention within the Democratic Party, that maybe the Democrats ought to dump Joe Biden and throw someone like an Andrew Cuomo or someone else in the mix. Obviously, Joe Biden's really struggling with campaigning in this environment of being locked in his basement and so forth, of social separation and so forth. I tend to think that a brokered convention is unlikely, but as long as these primaries are getting delayed, it's certainly a possibility. And if the Democrats go into their convention, however that actually happens physically, that gives the opportunity for a person to be dropped into that ticket. So it could be very interesting this summer when we see that play out. What is consistent between Joe Biden as well as Bernie Sanders is they want to increase taxes on the high income, high net worth, and business owners in our country. No doubt about it. They want to eliminate the Tax Cuts and Jobs Act. They want to increase the highest marginal rate, albeit different levels, but they both want to increase it. They want to eliminate the difference between long-term capital gains and marginal rates. So if you're a high-income individual, if you sell a stock that you've owned for a long time, no longer would you get a lower tax rate, you'd pay your highest marginal tax rate on that sale. And there are a lot of other tax changes that they would like to make, but clearly what they want to do is increase the progressivity of the US tax code. Higher net worth, higher income, and business owners paying a larger share of that federal tax burden. So that's just something that we need to understand. That's pre-coronavirus, but obviously I don't think coronavirus will change that dynamic greatly. Now, I do want to talk about the general election. Now, I think you would agree after 2016, you and I beat the polling industry up mercifully. We beat them up mercifully because we thought the national polls were there to actually tell us who was going to win the election. Ladies and gentlemen, national polls were never there designed to tell us who was going to win the election. All national polls do is accomplish two things. They influence perception and perpetuate momentum. After all, if you're calling into California to ask how many people support Trump, who cares? President Trump is never going to win California. So why are you lobbing calls into California? So if you keep that perspective on what national polls are actually there to do, I think it'll give you a little more comfort but over the next 217 days before the election. But what we do know is that this election is going to boil down to those states that we've heard so much about, Pennsylvania, Michigan, and Wisconsin. I completely agree. But I also want to add Florida to your mix. Keep Florida in the back of your mind. I have no idea why Florida is not getting more play in this election. All four of those states were won by less than 1% by the Republicans in 2016. So it's not unthinkable that any of them could change hands. So keep Florida in the back of your mind because the math is very interesting. Florida is a huge electoral college state. And if whichever party loses Florida, mathematically will have to win Wisconsin, Michigan, and Pennsylvania, all three of them. That's why it makes it so difficult for the loser of Florida to actually win the electoral college. Now, Bernie Sanders is uniquely challenged in Florida. I don't think he's going to be the nominee, of course, at this point, but it's important to point out he is uniquely challenged in Florida because of his pro-Cuba, pro-Venezuelan, pro-Palestinian stance. Any of you from Florida know that that's not a winning ticket in the great state of Florida. So he was uniquely challenged there. And there's some talk of some other states flipping. I'm just not seeing it at this point. Again, I think this is going to be much more of a traditional election rather than some kind of surprising election. I did mention earlier that we don't really know the effect of the coronavirus yet on a political terms to Donald Trump, but I think it'll boil down to three things. It'll boil down to his capability, his credibility, and how the economy does. And what I mean by that, believe it or not, 3.5 years into Donald Trump's first term, this is the first national crisis that he's actually had to manage. And so to the extent that he's managing or ill managing this crisis, that will go to his capability score. Do people have confidence in his capability of leading us through these national crises, which are inevitable in the future? In addition to that, does he have the credibility? We know he's been a little loose with some of his language, suggesting that we could be open by Easter, that this is not that big of a deal. We've had tremendous success with fighting the virus and so forth. That goes to, does that erode his credibility with those voters that he needs desperately to win the Electoral College, specifically in the Farm Belt, specifically in those states that I mentioned earlier? And then the economy. Well, I don't think anyone's going to blame Donald Trump from an economic challenge around coronavirus. But the question is, does that linger? Because even if everything opened back up on June 1, we're all back to normal. We're all booking meetings. We're all flying all over the country. Ladies and gentlemen, this coronavirus wave is going to continue to work its way around the globe. As it works its way around the globe, that's going to perpetuate the economic impact in this interdependent global economy that we live in today. So that hangover effect is what is the political risk to Donald Trump. If people's perception that the economy should be back up and running because we're all traveling already, and it's not, that could actually bode poorly for Donald Trump on that economic measure. Now, the other way to look at it is around undecideds, and specifically undecideds in the issues that matter. What we know is the top 3 issues for voters in 2020 are going to be healthcare, the economy, and immigration. Interestingly, coronavirus actually has an element to all 3 of those things. And George H. Bush said it well when he said, those undecideds could go either way. And he's absolutely right. But I will tell you this, interestingly, the trend has been the undecided numbers are coming down and they're trending in the favor of Donald Trump. Now, the last poll we had, the good poll that we used for month-over-month measurement was back in early March before any of us realized kind of what coronavirus was going to be. So we'll see when we get those numbers next week, how that trend has changed in the last month. And I think May will be the first month that we get a good idea of how much of this is being put on Donald Trump versus just something out of his control. Now, I do want to kind of move on. I want to talk about the House of Representatives. And a lot of people say, well, Jeff, why do I need to worry about the House of Representatives? Well, believe it or not, a House of Representative member, his equivalent or her equivalent military rank is a 4-star general. So as far as the government's concerned, they really care about these 435 House members. Now, you see this graphic in the bottom right-hand corner. This graphic is actually the 6 most highly gerrymandered House districts from around our country. Gerrymandering meaning politically drawn to favor one party or the other. Now, I challenge any one of you to find any logic in how they drew that map. But of course, logic's not the point. Politics is the point. But let's kind of break it down. We know the Republicans only need to take back 19 seats in order to gain a majority in the House of Representatives. And when you realize that there are 31 Democrats sitting in districts that Donald Trump actually won in 2016, you think they have a chance. Well, let me kind of burst that bubble right from the get-go. We're going to elect 435 House members in November of this year. We elect them every 2 years. Of those 435 House members, literally only 23 of those districts are actually considered competitive. Only about 5% of the House is actually in play. So right now, we don't believe the Democrats will lose the House. We think they'll get a decreased margin of victory, a majority, but they'll still have control of the House of Representatives. When we turn our attention to the Senate, it's a little more interesting discussion. When you're talking about the Senate, you need to understand why the Senate control is so important. The reason you want to control the Senate if you're in the same party as the White House is federal judges. Yeah, we know that Republicans and Mitch McConnell and Donald Trump have used that power very successfully over the last 2 years to appoint Republican federal judges. It's believed by the end of Donald Trump's first term, he will have appointed over 1/3 of the entire federal judiciary in this 2-year period. That was due to a rule change, interestingly, done by Harry Reid, the Democratic Senator Pro Tem. Now, what we also know is the reason you want to control the Senate if you're not in the same party as the White House is you can stop cold any presidential legislative agenda. Right there at your desk, doesn't even get the light of day. So that's why the Senate control is so important. Now, Democrats only need to take back 3 net seats if they gain the White House and 4 if they don't. And we elect about 1/3 of the Senate every 2 years, and this class has 35 senators in it. And of the 35 senators, quite honestly, there are only 4 states that are in play, split equally between the Republicans and Democrats. Now, and we believe right now, if the election were held today, there'd only be 1 state that would actually change hands, and that would be Alabama. Democrats picked up Alabama in a special election back in 2017. When you remember, the Republicans put forward a gentleman by the name of Judge Roy Moore, a very flawed candidate. Alabamans have decided not to pursue that direction again. They're actually deciding between Jeff Sessions again and Coach Tommy Tuberville, obviously very popular within the state of Alabama. So they're facing off, and they'll face Democratic Senator Doug Jones in the election in November. Right now, we think Alabama's likely to go Republican. But that actually changes the math dramatically for the Democrats. Now they need to pick up a net 4 seats if they gain the White House and 5 if they don't. And ladies and gentlemen, we just don't see any scenario where that's likely to happen. So right now, we think lacking that wave election, the Republicans are going to keep majority of the Senate. Now, there is one more race that we're watching as well, and those races are the state races. Now, we don't get into state issues very much. We've got enough to look at the federal level. But every so often, it's important to look at the state races, and this is one of those years. You see, it's the governor sitting in 2020, along with the state legislature sitting in 2020. Not necessarily elected, because we elect them in all different sequences. But it's the governors and legislators sitting in 2020 that'll oversee the next redrawing of those House district maps. That redrawing happens after the 2020 census, and those maps go into play in 2022. And you may not know this, but those maps last for 10 years. So as these governors and state legislatures could likely dictate the House majority leadership, or majority, for the next decade in our country. So it's very important to watch those state-based elections here in 2020. Now, at this point, believe it or not, I normally go my full presentation, not that I ever give the full presentation, but it's about 100 slides. We only did mid-40s today. If you're interested in getting all the slides, which go into healthcare and infrastructure and trade and all those other issues that that I talk about, you're more than welcome to it. You can just text to this phone number or email to this email address. Either way, we'll get you the full presentation out there, and you can see what we're talking about with audiences when we're given the opportunity. Now, a lot of people wondered, my gosh, Jeff, how do you deal with politicians every day and policies and without going crazy? And it's funny, I'm actually very optimistic about our country. And I think it's perfectly captured in this quote from Winston Churchill. He said back in World War II, he said, you know, you can always count on Americans to do the right thing, but only after they tried everything else. Ladies and gentlemen, all these problems we have in our country of our own making, and the good news, they're all within our own power to solve. And to some degree, that even includes the coronavirus. Now, a lot of people wonder, my gosh, we're in such a horrible political environment and the parties are so polarized and all this other stuff. Well, I could go back in history and point to some pretty ugly times in US history that we were able to work our way through. For example, like 1860, the beginning of the Civil War, or 1929 and 1930 with the Great Depression, or 1938 when there was this huge move to stay out of this European war that ended up fighting fascism around the entire world. Or maybe even 1968, when it seemed like the country was being torn apart. Ladies and gentlemen, there will be an event in our future, or it could be even coronavirus, that resets the political dynamics in our country. And that resetting is what I'm optimistic for. This is all a cycle. We may be in an ugly part of the cycle, but it is a cycle nonetheless. So with that, if you're interested in kind of keeping abreast of what my colleague Andy and I are reading every day, you can follow us on any of our social media or download our smartphone app. And I populate that with 1 or 2 or 3 articles a day that I think are uniquely interesting for whatever reason. In addition to that, you can sign up for anything we write on our website. There's no charge for any of this. It's just thank you very much for the opportunity to be here. And anything we write, we would just automatically email to you. So with that, I'm going to turn it back over to Mary Ann, and I appreciate your time today. Thank you so much.
Okay, thank you, Jeff. Thank you so much for that. So there was a question about reposting your email. So it's at the bottom of this slide here to get the slides and get the information. So
that's correct.
So just going to jump into some questions that were actually submitted prior to the webinar. So from Gloria, she wants to know, what does the CARES Act offer to nonprofits, and how do we most effectively apply and interface with this source of funds that if it's available to us?
That's a great question. I kind of glossed over that when I talked about the loan opportunity through the SBA, but that is available to nonprofits as well. So I would encourage you to talk to a local banker that is SBA qualified. I talked to my banker just so I kind of get his perspective as well, and they're still trying to figure out the rules also. Those are being worked on very aggressively this week, and they anticipate by Friday they'll have some good clarity as to exactly how it will work. But most importantly, Gloria, now's the time to get in front of your banker so that you're prioritized when they do get those details to get back out to you and what you can access and so forth. The other thing that will help, obviously, is the unlimited charitable deduction, the income limitation removal. Your biggest donors and so forth, obviously, would now have the opportunity to make larger donations, perhaps.
Great. And then there's a follow-up there for what about for independent contractors?
Oh, independent contractors, yeah. They're eligible for a lot of these programs. They're eligible for the unemployment if that's most appropriate for you. They would also be eligible for that SBA loan. So I think for that, I'm the only employee within my organization as well. So I'm kind of weighing theoretically. I'm fortunate enough I don't need to pursue that at this point, but I'm weighing if I were in a different situation, would I be going for the SBA loan or would I be going for the unemployment? Quite honestly, I don't think we know yet. Until we get the details of the SBA, I don't think you can make that decision. That being said, there is a huge backlog of people rushing into unemployment. We saw 3.25 million people, unbelievable, 3.25 million people filing last week. I think this week will be equally as bad, perhaps even worse. So I would suggest that as that independent contractor, we know you're eligible for that. I would go ahead and start that application process. Doesn't mean you have to actually file and go through with it, but I would already get queuing up in order to get that done. We hear reports that some people are spending hours going through the application process just because the website's so bogged down. So I would encourage you to do that sooner rather than later, just so you keep your options open.
Great. And this is kind of ties into that. So now that the law is passed and regulations are being established, what is the best way to communicate specific industry requests to the Treasury Department and SBA officials? And that comes from Richard.
Yeah, Richard, I think the best option right now, especially with our Congress people being dispersed around the country and being out of session, is to communicate with them. They are desperately trying to help their local economies. This would be your local senators and House members. I'd be communicating with them aggressively if you have something unique to your industry that they need to know, because that will likely fall into the fourth package if it's something that's broadly a concern around the country. So again, don't underestimate the power of being able to reach out to your local House members and specifically your senators. If you do contact them, do it in a handwritten note, keep it short, keep it tight, keep it specific. They will actually, that has the best chance of getting in the hands of that elected official. If you have personal relationships with them in a first degree or even a second degree, even better. And don't forget your governors too. Governors are playing a huge role in this whole process. Governors are getting a lot of face time with the federal government at this moment. That would also be a good avenue.
Right, and actually, I got an email from one of my local representatives. I think it's today. Actually, they're doing a lot of like virtual town halls that are with various elected representatives. I think our congressman is actually involved in this one, so I think that's a great way to contact them as well.
Yeah, I do a lot of work in the financial industry, and I am begging financial advisors, reach out and talk to your clients. Now's not a time to go under the rocks and try to hide. And I think representatives, I would be giving them the same advice. They need to be doing these proactive things with their constituents just to make people aware. People are so desperate for information now. And I wish I could share you the infinite amount of details around these things, but it's all being built as we go. Understand the round 3 package was the hull of the ship. I know I'm using a lot of metaphors today, I'm sorry, but the round 3 was just the hull of the ship. Now you have to build in all the infrastructure inside the ship, the engine rooms and the fuel stores and all the other things that have to go in to make that ship operate. And so that's what we're trying to figure out this week.
Mm-hmm. Great. Okay. So another question from Maureen. It says, are the $600 to $1,200 recovery checks based on gross income, including interest, or net taxable income?
Great question. If I remember correctly, it's on net taxable income. I apologize, I'm not exactly sure on that one. If you want to send me an email at the email below, I'll certainly get that answer for you. I don't have the bill in front of me, I apologize.
Okay, thank you. From Melissa, let's see. Can you please help us understand the confusion with the PPP program and the SBA loan? Is there a difference? Do any of the loans cover loss of business revenue. We are an event company and our shows are being shut down.
Yeah, no, loss of business revenue is a casualty event. A lot of people are pursuing their casualty insurance because most of them have a loss of revenue rider in there. Unfortunately, every company is going to interpret that differently. That's going to end up being settled by the courts. Bottom line is that will not be a short-term revenue source, in my opinion, for your business unless you have some extremely rich loss of business coverage specifically. I think the whole point of this the $10 million maximum loan to smaller business owners is to get cash in our hands quickly so that we can meet payroll, we can meet obligations, and keep the skeleton of the economy, if you will, intact. The worst thing that can happen in this whole process is we start dismembering the traditional economy because we don't know if we can put it all back together again. So that's why they're desperately trying to keep that skeleton together. So short-term revenue, it would be that loan source through the SBA. If you want to pursue the casualty loss through your casualty carrier, I certainly would inquire. It really is going to depend on your contracts. It's going to depend on how that's written within the casualty law. Some are more generous in their definitions than others. And that's going to be a case-by-case situation.
Okay. I'm going to do one last question. This one comes from Lee. What is the U.S. government's maximum capacity to offer fiscal relief? Is there a statutory limit? How many trillions of dollars?
Well, there is no statutory limit. That gets to that modern monetary theory. That modern monetary theory, if you buy into it, it says that there's an unlimited amount. And what's interesting about this particular situation is that this fiscal stimulus is happening all around the world. And when you think about what countries pay for people to borrow, on their bonds and so forth, it's based on the relative risk compared to all the other countries. So at this point, all the other countries are levering up their balance sheets as well, providing fiscal stimulus to their economies. So on a relative basis, I don't think anybody's going to look any better or worse than anybody else in big monumental terms. So I think we have a lot of flexibility to do that. I just tend to be fiscally conservative. I don't share our political beliefs. We don't think that's relevant, but clearly we're fiscally conservative. And what we're doing and adding all this debt, even before coronavirus, is very concerning to me. And coronavirus is an exponential factor above that. Literally, ladies and gentlemen, we're going to be adding overnight 10% of our total federal debt that we've accumulated in the 250 years history of the United States in 8 weeks. 10% increase. And I guarantee you it's going to be more than that when we start talking about program number 4. So that's just concerning to me. But theoretically, as long as everyone's is stimulating their economies, which they are, it should be a relative measure, and we aren't going to look any relatively worse than anybody else as long as we don't have some outsized issue with the pandemic. If we had some freaky number of deaths compared to the rest of the world, obviously that could skew those numbers a bit, but I'm assuming we're going to be as bad as everybody else.
Okay, well, thank you so much. We are going to have to stop here, but if you have any further questions for Jeff or anyone on the BigSpeak team, please reach out. We're here to help and support you however we can. Jeff's number and email are down here on this slide, and my email is on all of the webinar invites. So as I said, we are recording every session, which will be automatically shared with you, as well as all of those who are unable to attend. Jeff, thank you so much for joining us and going over all of this with us. It's a lot, and we appreciate you taking the time to walk us through it all.
Well, thank you to BigSpeak for making these available to all of our peers out there, because I think this is very valuable. Thank you.
Thank you. And to everyone out there in the world, thank you for joining us. Tomorrow, we'll be back with our regularly scheduled programming. Kevin O'Leary will be joining us, and that is currently open for registration. And actually, I am going to put the registration link for that in the chat box right now. Let's see if I can actually do this. So if you haven't registered for that yet, you can go ahead and register now. And that's happening tomorrow, Wednesday, April 1st at 10 a.m. Pacific. We hope to see you all then. This has been a special edition of the BigSpeak webinar. Thank you all. Please stay home as you can, if you can. Thank you.